We are seeing some unprecedented volatility in the stock market these days due to the trade war and tariffs, record high interest rates, and pesky inflation. And because of this, recession fears have resurfaced, so even the CEO of JP Morgan, the largest bank in the world, states that a recession in the United States is now, quote, a likely outcome. So that got me really thinking into my own financial plans when it came to a stock market downturn, and even worse, perhaps a full-blown economic recession. Now, I've been through the 2008 recession, and as I thought about what I would do myself if there were to be another recession, I decided to jot down some notes in which I want to share with you today. My hope is that this can help you protect your money and also help identify any opportunities in the upcoming recession for eventual profit. We'll also examine some data from previous recessions and hopefully gain some valuable lessons, and this video should prove especially helpful if you're feeling emotional or anxious about your investments or the state of the world right now. All right, so how did we get here? Because prior to 2025, the stock market was actually doing really quite stellar. In the past 2 years, it produced returns of 24% and 23% in the S&P 500. But now a large majority of the reason that the US is at risk for a recession has been largely triggered by President Trump's aggressive tariff policy. So at first it was announced that there would be 25% tariffs on Canadian and Mexican goods, as well as a 10% tariff on Chinese goods back in January. But as the months went on, the tariff policy just got more and more aggressive. Now, as of early April, more countries were added to the tariff list, and in a day deemed Liberation Day by the president himself, a baseline of 10% duties were imposed on a long list of international countries. The tariffs are currently paused for 90 days as of this recording, but these sweeping tariffs have increased the recession odds to 60% and 45% respectively from JP Morgan and Goldman Sachs. In addition to this, it's projected that Q1 GDP is going to come in negative, with the Fed's estimate being negative 2.8%. Now, a recession technically occurs when there are 2 straight quarters of contracting GDP, but still this indicator is not looking very good. Moreover, businesses are seeing a decline in consumer confidence and discretionary spending, and if there were to be broad layoffs in the entire economy, we could see a further decline of our economy and, of course, the stock market. Now, while we can't predict what a future recession will look like and how much it will negatively impact the stock market and our portfolios, we can still look at historical recessions and data around the market to better guide our decisions. If we're able to understand how bad market downturns in the past have actually been, it should give us more perspective on what's going to happen next if there is potentially a market crash. So let's go over 3 examples, the first of which is to look at the stock market cycles since 1962. Now consider the 1987 Black Monday market crash. This was a global stock market crash where the Dow Jones Industrial Average actually plummeted 22.6% in a single day, which is the largest one-day percentage drop in history. This crash was primarily caused by market overvaluation after a significant bull run where stock prices had tripled in the previous 5 years, growing 44% in 1987 alone before the crash itself. Now, even though there was a crash, one of the largest bull markets in history was driven by a strong US economy thereafter and resulted in gains of over 580%. Then the next crash, the dot-com bubble of 2000 and 2001, this was when the stock market collapsed due to frothy and speculative valuations of internet companies around the turn of the century. This crash wiped out approximately $5 trillion in market value, led to numerous bankruptcies, and resulted in the S&P being down 36.8% right after the dot-com bubble. And then subsequently, it went down another 33.8%, finally reaching the bottom. By 2006 and 2007, though, the market had fully recovered from that crash, and the subsequent bull market would go on to produce returns of 101%. Then, as you may or may not know, we had the 2008 financial crisis when many mortgages were being lent out to borrowers that were unqualified, and the entire housing market collapsed. This led to a bear market with a 51.9% downturn in the S&P 500, but if we look at what happened in history again, the resulting 12 years after that would produce 400% gains in the stock market. The point here is that yes, while a recession is bad in the interim, and it will definitely feel bad to see your portfolio down 30%, 40%, or even 50%, if history is any indicator, things should recover. So before we get into the next example, I want to share a quick message from today's sponsor, Rocket Money. One of the issues I face regularly with my own personal finances is the dreaded forgetting you're subscribed problem. That's where you sign up for an app and set up a monthly or annual plan, and after using the app optimistically for a week or 2, you eventually forget about it and stop using it altogether. Now, there is only one problem with that: you forget to cancel the subscription. When I began my expense tracking journey, I was shocked to find out how much money was going towards apps I didn't even use anymore. And trust me, every $8 to $15 monthly subscription definitely adds up. That's where today's sponsor, Rocket Money, can really help. Once you connect your bank account, Rocket Money identifies all of your subscriptions in a single list. From there, you can select the ones you don't want anymore, and Rocket Money may be able to help you cancel them with just a few taps. I personally use it these days just to keep tabs on all my subscriptions to make sure I never run into a situation where I'm paying for something that I don't use. You can also use Rocket Money to automatically monitor your spending by category and get notifications when you've exceeded your limits. Now, since I eat out a lot, I could do this with restaurants and get alerted when I'm splurging too much on, say, sushi. Rocket Money has helped save its customers up to $740 a year when you use all of the app's premium features. They've also helped customers save over $500 million in canceled subscriptions. So go to rocketmoney.com/Humphrey or click the link in the description to get started for free. You can also unlock even more features with premium, and again, that's rocketmoney.com/Humphrey to get started for free. All right, so thanks to them for sponsoring this portion of the video, and let's get into the next bit. Another cautionary tale and data point is about missing the best days in the market. In fact, the biggest mistake you can make when it comes to investing is literally not staying invested on the big days when the market is up. And that's because the big days will actually make up a lot of the percentage of gains in the stock market as a whole. If you ever check how the stock market is doing on a daily basis, I know that I check it every morning when I wake up, you'll actually realize that most days aren't really super volatile. In fact, usually the stock market usually moves between -1% and +1%. So if you look at this visual, you can see that it's pretty rare that the stock market moves more than 3% in any direction. And the crazy stat is here, if you miss just 10 of the best days in the market in the past 30 years, you could erase your gains by 54%. Missing 20 days will cost you 73% of your total gains, and missing 30 days will result in 83% less. That means the old adage, time in the market beats timing the market, is undoubtedly true. When it comes to surviving a recession, our strategy is to just stay invested. Because if we just miss some of the best days in the market, the average return that everybody talks about of the S&P 500, which is 8% per year, that's gonna be in big jeopardy. All right, this next chart right here is one of the ones that I want you guys to study if you can, and it comes from the Financial Samurai blog. So this is a bar chart of how every single year performs in terms of return percentages. Financial Samurai, aka Sam, says that, quote, "As long as we risk our money in stocks, we're always gonna be subject to volatility. We must accept this fact. The average percentage change in the stock market may go higher or lower depending on the economy. And you can see here that, quote, 38% of the years, the S&P 500 has fallen 10 to 20% intra-year. 16% of the years, the S&P 500 has fallen in excess of 20% intra-year. That means that market corrections and significant downturns are a normal part of investing in stocks, and you must accept volatility if you want to be a successful investor. Hopefully those charts give you some perspective when it comes to investing. Now, with all of this data at hand here, what is the best strategy for making money in the markets? It's pretty simple, but the answer is going to be to dollar cost average. A really great explanation of dollar cost averaging and why it's so powerful is the following example from a YouTube video that is now 5 years old. And it's actually from a channel called Mike's Financial Edge, and I will summarize it as best that I can for you. As you probably know, dollar cost averaging is the simple practice of investing a set amount of money into a certain stock or index fund at certain intervals of time. In Mike's example in the video, he wants to invest $240 into the market every single month. So here are two different stock charts. Most of us would probably like to see the top chart in our own experience. That's where the stock is trading at $20 in the first month, and by the end of the 10 months, it's trading at $60. On the y-axis, you can see is the price per share. As you invest $240 every month, that buys you 12 shares at $20 in month 1. And then in month 2, the $240 only buys you 8 shares since the price of the stock went up to $30 per share. And in month 3, the same thing happens. It buys you another 8 shares at $30 per share. Now this cycle continues and it goes for another 7 months or so. And at the end of this, the stock is trading for $60, and therefore your $240 monthly investment dollar cost average can now only buy 4 shares in that month. At the end of this entire 10-period cycle, if you add up how many shares you bought, you now own 62 shares and they are worth $60 a piece. So your total investment is worth a grand total of $3,720. Remember that you invested $2,400 in 10 periods or 10 months. So technically here you would have a profit of $1,320. Now the second chart is where it definitely gets mind-boggling in my opinion. So this is a chart that no one really wants to invest in because it would feel draining and emotionally it would just suck to invest in this type of stock. You can see that the stock starts at $20 per share, just like in the first example, but as you invest into that stock, the price rises sharply to $40 within 2 months. At this point, you're probably feeling pretty good. You're probably euphoric because you have a really good return in a short amount of time. But then let's look at what happens, because the stock's price tanks from $40 to $10 per share by month 6. And then it just stays there at $10 per share before it starts to pick up back in month 8 and 9, where it gets back to $20 per share. And then finally, by the end of month 10, it finishes at $30 per share. In this particular case, if you weren't dollar cost averaging, you would have had a really hard time buying the dip when it was trading at $10 per share for quite some time. Now, because you do dollar cost average, because you follow this channel and that's what we do here, you've kept your emotions out of it. By the end of these 10 months, you actually own 142 shares in this second example. That's simply because you were able to pick up a lot of shares when they were on sale at $10 per share. This results in your average cost per share being around $16.9, and because now the stock is trading at $30 per share, your total value of your investment is $4,260. That means in this case, you profited $1,860. So actually chart 2 was a more profitable scenario provided that you dollar cost average. Mike's point is that it's really hard to tell from a chart what the best investment is over time, and that's why dollar cost averaging is a really good strategy to stay consistent. I will leave a link down below to the full video by Mike's Financial Edge. It's not much longer, but it does have a third chart example, which I wasn't able to get to, but it will drive the point even further. All right, so you have dollar cost averaging down. You know to not get emotional if a recession happens, but what else can you do? If you are really worried about surviving a recession, here are some actions that you can take in order to be as financially prepared as possible. First off, if you don't have an emergency fund of at least 3 months already, you really need to start cutting your discretionary expenses now before any economic situation will force you to. Ideally, you are buffing up your emergency fund to up to 12 months of living expenses saved up, and you want to hold this in a high yield account and just sit on your hands if there is ever a recession. You don't want to make any emotional decisions at this point, and the emergency fund is just really good to have because that'll make you feel more comfortable holding your investments even if they are down, let's say 30% or 40%. Now that brings me to the second action item for your money, which is not to panic sell. You've seen the data from today's video, which is that for the past 100 years or so, after every single recession, there's always a resurgence. History shows that as long as you can stay in the market, stay consistently invested, and you're holding for a time period of at least 20 to 30 years, you will be fine. Now, in tough economic times, people love to make very emotional decisions. The thing about the market being down 30%, 40%, or even 50% is that even those people that say they are long-term investors will be tested. And honestly, it can be very tempting to sell everything when the market is down because you just can't bear to see any more losses. Now, the third action item today is to understand that there will be buying opportunities and to try to spot them. When the market is down a lot, that's where the most buying opportunities are because stocks are on sale. So as Warren Buffett says, be fearful when others are greedy and be greedy only when others are fearful. The times when there is max pain in the market is where you need to make sure you're not getting too emotional and remember the reasons why you got into investing in the first place. It's also the time to reassure yourself that the companies you invested in, either through ETFs or just by buying them individually, nothing fundamentally about these companies have changed in a stock market crash. It's just that the sentiment of the market is now reflecting a lower price for that same company. And if that stock is now all of a sudden trading at a discount, let's say 30% or 40% off, but it's still the same underlying company you were buying and therefore you were happy buying it before, you can think of the company on sale. My point with this video was just to try to ease some anxiety and fears that you might have because downturns and volatility, it's all normal and part of the economic and stock market cycle. History has shown us it's all but permanent. Of course, we can never predict what's going to happen in the future, but I like to bet on history. If you enjoyed this video, make sure to share it with a friend and don't forget to subscribe. Thanks again to Rocket Money for sponsoring a portion of this video. Also, if you'd like to check out my next video, make sure to click right here. It'll be a really good one, and I'll see you guys in that video or a future video on the channel. All right.